What on earth is going on in the stock market? 20 million more Americans lost their jobs in April, and yet the US stock market has had its best month for decades. With the S&P 500 back where it was just 6 months ago, before the coronavirus was even a glint in its father's eye. This makes no objective sense.
Since April, job losses have continued to mount, and yet the market has climbed even higher. How can the stock market, driven by the USA, be doing so well when the evidence of the economic devastation is overwhelming? And it is a US-driven phenomenon. Their stock market is doing far better than the UK and European indices, with the FTSE 100 still significantly down over the same 6-month window, and EU indices looking similar.
And yet, UK and European governments have protected millions of jobs through various furloughing schemes. You might have assumed that such massive handouts from the UK and European welfare state would instill the stock markets with confidence, compared to the US, whose handouts have not been quite so generous. But this is not what the markets are telling us.
So what is going on? Is the whole US stock market just one big bubble waiting to pop? In today's video, we're going to be looking at why stocks are doing so well right now despite the coronavirus crisis, and in particular, whether you should be avoiding investing in US shares. Let's check it out. Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
You could leave the predictions to the experts and invest with a robo-provider like Nutmeg. Sign up to Nutmeg using our link, which will get you 6 months without fees. The link to the offers page is in the description below. Now let's get into the video.
America and technology. A quick look at the tech-heavy Nasdaq provides a clue. It is trading at where it was at the start of the year, i.e. not down at all. And that's because tech firms have had a pretty good crisis. We're all ordering more online. Great for Amazon, whose share price is up 25% year to date. Office staff are working from home using Microsoft Teams, boosting Microsoft's revenue and its share price.
Netflix, of course, is doing well out of the lockdown. And despite businesses slashing advertising budgets, the little that they are spending is being spent on Google and Facebook ads. So one reason the US stock market is doing better than European ones is because it contains tech giants which are highly resilient to the crisis. Then there's the theory that confidence in the country filters down from the top.
Follow the leader. Trump is clearly not fearful of this virus and spent a while talking about it like it was a minor inconvenience sent by China to test him. His blasé attitude may now be helping to maintain more of a business as usual national feeling, whether for good or ill. Americans famously love their freedom.
The UK and EU governments, meanwhile, went full-on pro-lockdown, to the point where the populations are now in favour of lockdown continuing almost indefinitely. And the markets see this and panic.
Can't see the wood for the trees. It is also worth remembering the adage, the stock market is not the economy. It is large companies that are listed on stock markets, not the small ones. And the large firms generally have the cash reserves and the brand power to survive. Stock markets therefore only show a strong subsector of the bigger economy. And that is one reason why, despite the scale of the economic catastrophe facing us, that the S&P 500 and FTSE 100 have not seen greater falls.
Hoping history will repeat itself, investors are also thinking about what happened after the last financial crisis. Since the bottom of the last recession, US shares have climbed over 300%. There's a lot of hope out there that this will be replicated. We're not so sure. When a climb is mostly based on hope, you're entering bubble territory.
We're watching the prices of US stocks climbing to ever crazier highs, and we're thinking there's gotta be a correction soon. We're looking at the facts on the ground. There is a worldwide coronavirus pandemic wiping out wealth and livelihoods at a scale never before seen. Surely the US stock market cannot continue to outperform appalling economic fundamentals, and a reality check correction is on the way.
Market correction coming. American news outlet CNBC ran with a piece at the end of May that investors should brace themselves for a tumultuous June. They too are looking at the economic fundamentals, and they're predicting a 10% or higher cleansing correction in the month.
The prediction is based on momentum traders who rush back into the market out of the fear of missing out on a bull run climb. The thinking is that if the market starts to pull back in coming weeks, they will throw in the towel, seemingly confirming the market's worst fears and triggering a mass panic sell-off.
Trigger points. There's a couple of big scheduled announcements of fundamental economic performance on the horizon, being second quarter GDP and second quarter corporate earnings. Either of these coming out worse than expected could be the match that starts the fire. There are also some psychological milestones to look out for. the S&P 500 just reached 10% below its all-time high and it didn't trigger a sell-off.
Its all-time high was 3386 on the 19th of February 2020. If not at the minus 10% mark, then there must surely come a time soon when investors start to think that the market is not in fact worth as much as it was before the coronavirus pandemic.
Bubble pop when the magic fades. Investors are looking at prices rising to silly highs and are starting to notice that something might be amiss. The stock market is made up of people, and people are a suspicious bunch. The S&P 500 won't be able to climb much higher before the cognitive dissonance between a crumbling economy and a climbing stock market snaps, and the party comes to an end.
Why we're still investing in the US. We're still buying into the US stock market. Individual companies and sectors keep showing up that look attractive. Like when I bought into oil when the US oil market crashed in April. Healthcare and tech are both having a good crisis, and it makes sense why these sectors would do well during a virus-based recession.
We regularly drip feed money into stock markets around the world, including the US, and will continue to do so. It might be that prices continue to go up, and if we were to change our regular investing strategy, then we would miss out. That said, we are holding back from any major market-wide buys right now, and if the correction does happen, then we'll be ready with our cash reserves to take advantage.
Be ready to fill your boots. We suspect that there may be value to be found in both healthcare and technology in the event of a market correction. They should be particularly vulnerable due to their recent outperformance. We think that many investors may decide to disproportionately take profits in the areas that have done best, meaning they'd look to cash these in quickly in a correction, pushing prices down. If the fundamentals remain strong, we'd be looking at these sectors with great interest during the bargain buying spree to come.
Question of the day: what is going on with the markets right now? Give us your take in the comments below. Thanks for watching. On this channel we talk all about personal finance, investing and all things money, and if you want to see more great content, please click the subscribe button below.
This is moneyunshackled.com. See you next time.